Good morning, Manish. It's
Good
time
morning.
for time for us to hit the good old podcast topics. We got a couple of them I think are going to be pretty well received as we discuss. They're sort of both hot topics in this case. First one, big one, is about inversions. Right, we've got an interest rate inversion that's happening this week, or started to occurred this week, and we're going to that one out, and then we'll discuss some about the recent private letter rulings with variable annuities and management fees. So on the inversion piece, you're the expert. You're the lead portfolio manager. Let's dig in.
Yeah, not an expert on yield curve, but it's top of mind. So, I wanted to write a blog about it and dig in and do some research, and that's coming out in a couple days here. And so let's get down to the basics. So a yield curve inversion, at its core, means that you are getting paid more on short-term rates than you are long-term rates, right?
Mm-hmm.
And there's different definitions of a yield curve inversion and what data to actually use. As of recently, on August 14th, it came out that the quote-unquote main yield curve inverted, in this case, the 10-year and the 2-year. I've seen data all over the place, from 3-month to 30-year to 20-year, 1 year. There is no consistent sort of definition, because it's really not a defined formula. It's just a concept, right, of a yield curve inversion, and people use different data points to fit their narrative.
No, I think that's absolutely spot on, because the real key is the question that everybody's asking is, if this is such a great predictor, well, wait a second, you're telling me that the numbers have all changed, the data points are different. How can you predict if you don't start with the same piece, right?
Yeah, it just depends on who's writing it. So, you can, what I found, I wanted to define it first of all. And when we define things, when we do studies, we want to go back as far as possible. So the first goal was to find consistent data that goes back as far as possible. So I settled on the 10-year and the effective federal funds rate as my two data points for long and short term. And here's the key, and this is why the data is important. Let's say you use a 3-month, for example. The difference between the constant maturity and the other version, which is the secondary market version, will totally miss an inversion in 98, depending on which one you pick. So it makes a huge difference picking one or the other and defining your data. And so rather than cherry picking to fit the narrative, I said, let's just find data points that can go back as far as possible and consistent without any breaks or adjustments. And that's how I came up with the 10-year and the federal funds rate, and I was able to go back to 1962. And
That
so,
seems reasonable.
yeah, and I just wanted to go back as far as possible, get different market cycles. And what was interesting is, yes, it's a recession predictor, like you said, depending on how many months you want to look out. Like you said yesterday when we were talking, does it still predict a recession if it happens 3 years later?
Yeah, that's my biggest issue, right? I mean, so I always laugh. I think of those, if you may have seen Bruce Almighty, the movie with Jim Carrey. There's a point at which he's wanting a sign, he's wanting a signal, and he's praying to God in his ultimate humor, right, of how he needs this sign. And it gets to the point after several attempts, literally a truck pulls in front of him, which is full of road closed, beware, turn around, right, all these signs. He still ends up pulling off to the side and wrecking his own car. But the point is, it can be a sign or a signal, but I hesitate to use the word predictor, because I've seen, this studies show even 3 years out. I've got one study we'll put show notes in that showed 3 years out, there's still typically a positive return. Well, look, anything that happens today is a predictor of what's going to happen in the future. If you always say because X happened, Y happened, how much time do you give? I think that's crazy. I think you should define, is it 2 years? Is it 18 months? Is it, before you start using the word predictor? I think it's a sign. It's a warning sign.
And that,
it's
even
not
that
good
study
for the economy.
that study that you showed me, it doesn't say what dates, what inversions, and this is the clickbait shit that's all over the place. 3 years later, it's positive. After what? After the last 2 inversions? After the last 20? So you just have to pick your data points you're comfortable with. And so what I went with was a sustained yield curve inversion. So,
and I like that.
The yield curve has to invert for 40 consecutive market trading days in order for it to count. If it inverts and then goes back and normalizes, I don't find that as useful data. So I went back and said, all right, 40 consecutive days of an inversion using the 10-year and the effective federal funds rate. And I don't care about recessions, frankly. I know that, might come across as flippant, but, our focus is bear markets and catastrophic market losses, which can happen outside of a recession, and in many cases has. So what was interesting is that, yes, bear markets happen in and around a yield curve inversion. It doesn't mean it's going to happen a month. It might happen 2 to 3 years later. And sometimes, in some cases, the bear market starts and then the yield curve inverts afterwards, right? You got to take this all with a grain of salt, because a lot of this is in hindsight. You can't do this analysis future peaking. It's really looking back and saying, because think about it, right? If I'm going to say 40 consecutive days, I'm not going to know about an inversion until the 41st day, right? Looking back 40 days. So it's not. By the way,
and Manish, you need to trademark future peaking. I think that's a great phrase.
And when we code systems, it's called a future peaking system, where you are essentially, it's not a true buy signal because you don't know until 41 days later. But that's not the point of this. This is not necessarily, something you trade on, but that's what I wanted to prove. I wanted to say, all right, yes, it's not healthy when a yield curve inverts. We can all agree on that, right?
I would
just
agree.
From a logical,
Absolutely.
Common sense point of view. But it doesn't mean that the, retirement account mass murderer standing in front of your door the second it happens. There's been instances where the yield curve inverts and you can still have 15, 20, 30% more return before any trouble happens. And also the sustained portion is important, right? It has to be sustained for a certain amount of time. Once again, depending on how you define it, to me, it's been sustained because it happened on May 24th, according to the data I used. If you use August 14th yield curve, then, you can define sustained, or CNBC, whoever the hell is doing the study. But the bottom line is bear markets typically follow yield curve inversions. Just the timing of it is uncertain. And they're usually, catastrophic bear markets because it's not a healthy phenomenon to occur.
Right. I mean, it's funny because oftentimes we in the business get so busy looking at statistics and details and so forth, and it's sometimes, I think, somewhat humorous, but also very valuable to break it down to a client level understanding. If I'm going to lend you money for 2 years versus lending you money for 10 years, or in your case for this statistic, the Fed funds rate, that which is loaned longer should have a higher return. And the inversion is the whole concept that lending you money for 10 years, I'm not going to make as much as lending money to you for the next 30 days or whatever target that we were to pick. That's insane, right? I mean, that's clearly not a good sign, especially if you're the one that just loaned the 10-year money.
Well, yeah, and the most dangerous words in investing is that it's different this time, but I'm going to say it could be different this time. I mean, we're talking about yield curve inversions that aren't with a backdrop of negative yielding bonds. I mean, there's $15 trillion worth of global negative yielding bonds. Maybe you just need to look at it in a different light. And this is why you don't use this as a trading system, because it's just not something that's accurate.
Right.
But, so that's something to be tossed around. You got to look at the other side of this. Yes, the yield curve inverts, but what if it stays inverted and the market continues to rally? There's no guarantee.
So Manish, what you probably know this right away. I just don't recall. What's the last day? Was it 2007 was the last inversion, or was it 2008?
I think it was early 2008.
Yeah, early 2008. So here's something that I think everybody needs to take a pause on, and that is if you really want to sort of blow your mind, go YouTube observer effect in quantum theory. But ultimately, the concept is any particular test, when observed, is affected by the observer. And it's the really smart people agree that you can't undo that effect. So here's the point I'm making is that in 2008, 2007, yes, internet was big. Yes, we all had our phones. But I think the volume of data and talking heads, and I mean, obviously we're having a discussion here. We're trying to boil down to base facts rather than just clickbait crap. But I think the fact that it's such a big topic right now goes to your point that it may not have the same effect because of the fact that we're all observing it. We're all talking about it. We're all aware of it. So does that change the outcome of what traditionally an inverted yield curve would have? I think it's very possible.
Yeah, there's two sides of that, right? Are we all talking about it, or just because of social media and CNBC, it seems like we're all talking about it? We could have been talking about the same thing, 30 years ago, just by the water cooler instead. So, but there's definitely some validity that the more people use these things, the more irrelevant they become.
Right.
And the second part of this is I actually turned it into a trading system because I wanted to go back and code the algorithm that said, all right, let's buy the S&P when the yield curve inverts, and let's sell when it normalizes, and then also reverse those traits to see what happened. And yes, there is a clear correlation between risk and an inverted yield curve, whether you measure it with the bear markets that happen around it or just the trading system. It was almost a 7% annual. It was actually, since 1962, there was a negative annualized return if you were to buy when it inverts and then sell when it normalizes. So, you do, the reason we go back as quants and test these theories is to make sure that it confirms your initial thought that it is bad, right? You can't just, as a money manager, say something is bad and not necessarily go test it in terms of risk and bear markets. And so, yes, I think to wrap this up, the conclusion is that, you and I both have a hate relationship with financial media, and yes, it is bad, but it doesn't correspond to markets in turmoil. Go sell everything tomorrow. You just, like always, figure out your risk score, figure out your comfort level with risk, and roll with it. Nothing that this shouldn't change anything.
Well, and I would agree that, of course, with this historically long bull run, right, the cheap passive has been the predominant player. Everybody seems to think that's the way to go because it's different this time. Well, if that's the case, then none of this should matter. You shouldn't even be talking about it or looking at it, right? Because if you're a cheap, passive, strategic investment mindset, well, you're going to hold the stuff anyway, right? So it doesn't really matter if the yield curve inverts.
Well, nothing matters.
As a tactical man, right? Exactly. As a tactical manager, we want to know these kinds of things so that we know how valuable the sign is. Is it something that we, the hair on the back of your neck stands up? Is it something that is just an alert and we look for other confirmations? It's important to the tactical side, the strategic side, not so much. So that's.
Well, I mean, in terms of managing money, closing point, in terms of managing money, it's absolutely useless. It's just a backdrop stat that, maybe alerts you that there's risk, but I mean, you can't trade on it. It's pointless.
Yeah. All right, so as we move on, let's hit another topic. This came to light this week. You sent me a notice, said, hey, did you see this? And it's in regards to non-qualified variable annuities, a couple of private letter rulings. You want to touch on that?
Yeah, I think first and foremost, we're not going to get into the conversation about the viability of annuities. It depends on the client situation. There's a lot of, emotional responses out there in the industry about, bad salesmen or how it's good or bad. Listen, it just depends on your situation. I can make the argument both ways. But in this case, it was really just the ability to deduct fees from non-qualified annuities. And we work with a lot of advisors who use these fee-based annuities, and they've historically shied away sometimes because, frankly, they couldn't deduct management fee. And, we don't run charities here. If you're not going to get paid for your work, you're going to find another solution. And so the letter that I sent you was an IRS letter that stated, I think there was 4 firms that were able to deduct management fees from non-qualified annuities. Now, there's different caveats, which I think you'll touch on. But it was interesting because I think on one side, this is going to be very helpful because they'll get more attention. They'll be able to serve clients better because, frankly, they can now get paid, right?
Yeah, I mean, that's like anything. A hammer is a great tool to a contractor. It's not such a great tool to the person getting hit over the head by the murderer. A non-qualified annuity is a good tool when used properly, and we'll leave it at that. The real kicker is, I think, the fact that it's not standardized in the industry. That's part of the problem. Now, let me give you a couple of examples. Some annuity companies treat it as a client withdrawal, period. and it just goes straight to the 1099. It's coded on a statement as a client withdrawal, right? There's really nothing there that makes it what I'll see easily defendable by the CPA who says, wait a second, I've got a client who's itemizing and I'm going to deduct that because the statement looks like it went straight to the client. There are some annuity companies, I'll pick on Security Benefit because that's where I got started in this industry, right? They had a little different approach. They actually line item it on the statements as a management fee, right? And then and then they go ahead and code it as it's on the 1099 as a withdrawal. But again, you've got this more easily defendable piece of, well, it says that it was a management fee. So if the CPA validates that there's a reason to deduct it and the client can deduct it, then they could. But there's also the other end of the spectrum, which is, it's now we've got Nationwide and Lincoln and a couple of them that, have these private letter rulings that say, okay, now it's okay. We're just, boom, it's going as a management fee and it's not even going to show up as a client withdrawal, period. And that's, honestly, it's where it should be.
But it makes you wonder that these firms are on that letter and were they the ones lobbying and pushing for it? And then they don't just make this an industry rule. So now you're choosing which firms can do it and which can't? Like what? Why?
Right.
Why?
Yeah, I know. It's, exactly. Lobby city.
And it just happens to be the biggest insurers out there?
Yeah. Well, and for lack of a better phrase, if I were a betting man, I'd say that that was part of the lobby was not only does this need to change, but it needs to change just for us. Sort of mentality, right? Because it gives them a clear advantage.
On the 403B side, you remember the biggest, they went through a huge change on the 403B side, and then who was behind it? Valid, CREF, Fidelity,
Right.
And so
right.
I think maybe this is the same thing where they're, if they can corner this and maybe push out the smaller ones, who knows?
Yeah, well, and there's another detail which I think is important because when these withdrawals are effectively up to this point, right, if they're taxed because they appear as a client withdrawal, now all of a sudden you also have to deal with, is the client under 59 and a half? Is there a penalty? You think about all the red flags that show up for the IRS that the CPA is having to counteract. Forget about whether or not it's a pro rata withdrawal, and you get into more detail there, which we won't do in this call or this conversation. But it gets kind of messy, and this is the part that I think is interesting, is that if I were to flip a coin and say, well, what would if I had to guess, and I didn't already know, qualified or non-qualified, which one would be okay to pull money out of? You'd think it'd be the non-qualified, right?
Yeah.
Rather than the qualified. But for years, you've been able to pull management fees from a qualified annuity without a problem. So the very same companies are not, haven't been able to do the non-qualified side. It's an interesting situation, and hopefully, very quickly, we'll switch from a few companies to all the companies.
And I think,
and that way, everybody has the same.
It's positive to me. Bottom line is, anytime you can give clients, investors more access to advice, it ends up being a positive, because you and I both personally know advisors who've shied away from this.
Yeah.
Frankly, because they can't deduct the fee.
Well, and here's what I'm really curious to see. Since Nationwide is the one with the letter, and they bought Jefferson National, you and I both know that we work with the Monument product, and that product it's been around about 10 years. When it came out, it was solely dedicated to market to the advisor, right, to be able to have their client managed. It's a super dirt cheap, no rider, no nothing. It's just the non-qualified wrapper. And yet they were one of the companies that that treated it 100% as a client withdrawal. Yeah. So, that was always the headache was, well, here, even in my former role, when I'd say, look at this product, but then, the client's under 59 and a half, or the tax circumstance, it was ugly. They didn't make it a very smooth process. And now, hopefully, with the Nationwide JeffNet combination, why that will smooth out. Again, I hope it smooths out for everybody. Just becomes a rule instead of a private letter.
Yeah, it's not over yet. We're going to have to see what it turns into. How they handle riders that restrict withdrawals. Are they going to give a waiver for that? There's too much to cover. So
yeah.
All right. What else? What do you got going on?
All right, so we've got another one. I guess it's time for recommendations, and I'm going to throw a different one in here. I watched a movie. I haven't been to a movie theater in a long time. I love movie theaters, but it is what it is, right? Time goes by, and you haven't been in one. But I went and watched the movie Stuber, which I had seen nothing about. But we drove by a movie theater, and my wife had a project, so she's like, "I need you not to be in the RV." It was a really high end deal. So I went and picked out of these four movies. I picked Stuber. It's basically about, if you've ever taken an Uber or a Lyft, something like that, you'll probably and you're not. Let's just say not upset very easily, because the language is pretty heavy. But it was funny. It was definitely worth a watch. I was pleasantly surprised, and I've given this recommendation to several individuals as well. So yeah, definitely worth a listen.
Is it in the movie theater, or where can you find it?
It was in the movie theater. I think it actually still is in some places. Again, but you can't be easily offended. There's a lot of shooting, cussing, all kinds of things, but it is definitely humorous. So
cool. Yeah, I'll check that out.
It's a good watch. You trust me, bro. You're gonna find it funny. You're gonna enjoy it. So
well, I'm going through a midlife crisis, I think, and so my recommendations for the next, I don't know, year maybe are going to be all around that. So I was talking to a friend of mine who, we're talking about working out and stuff like that, and he said, if you have an office job, you'll be utterly shocked how little you move. And I'm like, yeah, whatever. I walk to get my lunch, and I do things here and there. I have a standing desk. And so I got this little pedometer. My wife makes fun of me because it's for the old people. It doesn't sync to your phone. It's battery operated. You put it in your pocket. It's called 3D fitbud. And because I didn't want another thing I can charge, I didn't want an Apple Watch or a Fitbit or anything I just wanted something that count fucking steps. And so I got this thing, and so my first day at work, a full day of work, a couple calls, walking to get lunch. I looked down and I took 2,200 steps, which is pretty bad. On a regular day, 10,000 steps is what they quote unquote say to get to, 15 if you're really active. I was convinced that I was walking a lot, and 2,200 was a joke. So I've had it for a week, and on the weekends I'm like 17 to 20,000 because I'm all over the place taking the kids places. But it's super helpful because during the week you do have to force yourself, because you get a long day, you get some calls, market's doing this and that, and you look down and you haven't moved.
Well, I mean, I'm gonna make it more painful. You're moving a ton versus what I'm moving. I mean, that's why we're really having to figure out here, our first year of full-time RVing, what we're doing in the evenings, what we're doing to get out and move, because I have a 43.5-foot RV. And typically, I mean, you talk about, walking to lunch. Well, there's nowhere to walk. I'm in an RV park, right? I mean, as far as like just heading out to grab something to eat. So I've seen it as low as, at the end of the day, 300. I mean, that's Christ. You can't eat a peanut butter sandwich and work off 300 steps. That's just not gonna work, right? So yeah, you really have to get out, go fishing, go hiking, go biking, go whatever. And
listen, you obviously don't need a pedometer. We don't need any of this stuff, but it's helpful just to to remind you how maybe lazy you were during the day, and to go force yourself to do something. So. I don't know.
Yeah, a mirror will do the same thing.
Yeah, that's also helpful. Or trying on a shirt from 10 years ago. But anyway, that's my midlife crisis recommendation of the week. It's $18 on Amazon. It could make you get depressed. It could make you happy. I don't know. That's on you. But so far it's been a blast.
All right. Well, on that note, let's finish this up. So definitely like, share, subscribe, etc. We've got the podcast. We're doing this about every week. Also, we want to know your comments, concerns, questions, topics that you might want. Shoot those to info@potomacfund.com. If you don't remember that, just go to our website, potomacfund.com, and you can go to the Contact Us page and throw in your comment or suggestion, etc. Love it. So thanks for listening. Thanks for watching. We're out. Peace.
Thanks.